Hey there, welcome back to Finance Friday. It's another special edition of Money Girl. This is the show where I answer your burning money questions. Today we got a great topic from Bonnie, who says, I know that I should be investing more, but I really get worried that the stock market will have a major crash and then I'll be sorry. I've heard about an investment called a buffered ETF that limits potential losses. Can you do a podcast that explains buffered ETFs and how to buy them? Thanks so much for your question, Bonnie. I know many investors share your concern about losing money or selling investments at the worst possible time. Buffered ETFs or exchange-traded funds are an excellent option for certain investors. This podcast will explain how buffered ETFs work, who should consider owning them, and their pros and cons based on your investing goals. Welcome back, everyone. It's episode 965 of Money Girl, and I really appreciate you being here and downloading the show. If you're new, I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. You can learn more, ask any money question, and sign up for The Money Stack at lauradadams.com. You can always get the newsletter for free or become a paid member with access to my live educational and Q&A events. Additionally, you can ask a money question by leaving a voicemail by calling 302-364-0308. I really appreciate Bonnie's question because I do think there is a lot more talk about buffered ETFs these days. So we'll talk about what they are. You know, they are a relatively new class of exchange-traded funds that launched in 2018 and are gaining popularity. According to Morningstar, there are over 400 different buffered ETF funds with about $70 billion in assets. They're also known as defined outcome ETFs because they limit your potential losses and your potential gains. So that makes buffered ETFs an excellent choice for someone like Bonnie who wants their money to grow but also wants to limit potential risk. And I'll talk more about the pros and cons. Investors typically use buffered ETFs as a complement to their portfolios or even as an alternative to bonds for fixed income, but they come in various risk-reward combinations that you can customize. For instance, some buffered ETFs offer more gains when the stock market rises, while others provide investors with more downside protection when markets decline. So it's an investment vehicle that allows you to make money when the financial markets rise, but limits your losses when they fall. Buffered investment strategies aren't new. You know, they've existed for many years in investments like mutual funds, annuities, and other products sold by insurance companies. However, the ETF versions are becoming more well-known and accessible to investors. How buffered ETFs work depend on the amount of protection the fund manager plans to offer on the downside. That's known as the buffer. And the return they plan to pay on the upside, known as the cap. So these goals are achieved by investing in year-long options contracts where the manager buys or sells shares in an ETF at a set price or before a specific date. And I'm not going to go into options here, but, just understand that they are the underlying investment vehicle that makes a buffered ETF product possible. In general, the buffer is fixed, such as ranging from maybe 8% or up to 20%. Again, that's the amount of protection you get from potential losses. And the greater the downside protection, the smaller your potential gain will typically be. Let me give you an example. Let's say you bought the Innovator S&P 500 Buffer ETF last year, and that product goes by the symbol BAPR if you want to look it up. If you bought it last year, you'd have a 9% buffer against losses for a year. The fund tracks an index fund, which is the SPDR S&P 500 ETF trust that goes by the symbol SPY. Therefore, if SPY drops up to 9% during a 12-month period, you would lose nothing because 9% is the buffer. But let's say it drops 10% by the end of the period, you would have a 1% loss. Again, you're protected for 9%, but losses above that amount you would incur. So you would have just a 1% loss in this example. Now, that limited loss is terrific. However, it comes with a cost. For example, the potential 12-month return of that product, the BAPR, was 18.3%. So that means if the SPY, again, that's the the underlying index, if it had a 20% return, you would forfeit 1.7%. So the maximum return you could get would be the 18.3%. That is your upside cap. Many people are willing to accept limited returns when they understand that their potential losses are also restricted. Buffered ETFs give you some amount of predictability in your portfolio. That makes them similar to a one-year bond that you hold until maturity. However, there's no penalty for selling a buffered ETF early. You can exit at any time without incurring additional fees. And at the end of a 12-month period for buffered ETFs, the fund rebalances by buying new options. You can automatically roll over your money to the fund's next 12-month period or just leave it. So that's a summary of how these products work. Let's talk about the primary benefits of using buffered ETFs. I think the main benefit is that they provide investors with a cushion or that buffer against losses. If you're a nervous investor or you just can't tolerate much volatility because you're nearing or in retirement, downside protection might help you sleep better at night. With a buffered ETF, you know its cap is the best case return and its buffer is your worst case loss. The potential upside can be much better than leaving cash sitting in a CD or a high-yield savings account. While deposit accounts have no risk, they pay low returns that typically don't beat inflation, and that just causes your money to lose value over the long run. Buffered ETFs trade just like a regular ETF on various financial markets. You can buy and sell them using a taxable brokerage account or a tax-advantaged retirement account. Of course, it does need to be on the menu of options for that investing firm. Now, let's talk about the downsides. While buffered ETFs have many benefits, there's no financial product that is without its downsides. I think a primary con is having limited or capped upside potential. When the markets are moving up, you won't get to take advantage of the full amount. If that would frustrate you, then a buffered investment will not be your friend. Additionally, there's no guarantee against losses, as you can still incur amounts exceeding the buffer. For instance, if the fund loses 20% and you have a 9% buffer, you're still down the difference of 11%. Additionally, buffered ETFs typically have higher fees than a typical actively managed diversified fund because they're just more complex to manage. And you always hear me say that investment fees erode potential profits. Lastly, a buffered ETF's cap and buffer only apply in full if you own this product for the entire year. If you buy or sell mid-period, the downside protection and the potential return will be different than what's stated for a 12-month period. So when thinking about who should consider owning buffered ETFs, I think the pros and cons of these products make them excellent for anyone who wants to limit potential investment losses and gains. In general, this describes investors who are nearing or already in retirement. For instance, if you retire at 65, you will likely need your investment portfolio to beat inflation and grow moderately for 20, 30, or even more years, depending on your health. But a retiree can't afford a major portfolio crash that would derail their standard of living. We don't know Bonnie's age or retirement time horizon. However, we do know she's a conservative investor who is not comfortable taking too much risk. While a buffered ETF doesn't eliminate risk as you get when buying CDs or keeping money in the bank, it gives you a narrower range of potential outcomes to count on. Knowing you could lose a little but not a lot could be the ticket for becoming a more comfortable investor. However, if you're relatively young or comfortable taking investment risk, then traditional index funds may be better for you. If you have a time horizon of at least 10 or 20 years, embracing volatility can really pay off. Accounting for fees, uncapped index funds have historically paid investors an average annual return of about 10%. So if you're interested in looking into buying a buffered ETF, there are several fund families that offer them, including Innovator, First Trust, and BlackRock. Different brokerages such as Fidelity, E-Trade, and Charles Schwab will sell them. So once you open an account with a brokerage firm, you can purchase any products on its investment menu. There are also variations on buffered ETFs, such as those that don't cap potential returns, but require you to give back a percentage of the potential return. For example, if you must return 3% and the market climbs 8%, you would earn 5%. But if the market skyrockets to 30%, giving back 3% would still leave you with a 27% return. So, in other words, how the caps and the buffers are calculated can differ from fund to fund, so be sure you understand them. To sum up, buffered ETFs offer a trade-off between potentially lower returns and smaller losses. They're not for you if you don't need or want to manage risk and you want maximum growth. However, if you're willing to forfeit market gains to protect yourself from losses, buffered ETFs are excellent tools to consider. If you're enjoying Money Girl, please take a moment to let us know you're getting value from our weekly episodes by rating and reviewing the show in your podcast app. I'll thank you in advance for that. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank the amazing team that works on the show. Steve Rickeberg is our audio engineer. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing and publicity manager. And Nathaniel Hoops is our marketing contractor.